Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 55 on March 30th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Zayo Group Holdings, Teva Pharmaceuticals, and Macy's. And we discuss three new trades on Kronos Group, Russell 2000 Index ETF, and Advanced Micro Devices. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know in order to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets were slightly up a little more than 1% this week. The Dow Jones Industrial Average rose 426 points, finishing the week at 25,928 points. The S&P 500 index ended the week 33 points higher, closing at 2,834 points. Now, this is a slow earnings week. There are only 109 publicly traded companies in the U.S. Who are planning to announce earnings this week. So it'll be pretty light this week. On Monday, we'll hear from Eastman Kodak. On Tuesday, both Dave Busters and Gamestop will announce quarterly earnings. And then on Thursday, I'll be listening to earnings for Constellation Brands. They own quite a few different fast food restaurants that many of you would be familiar with. Now, the topic of the week this week is income trading. And I should probably, I know we talked about income trading back in December. This is one that I should sort of repeat every couple months anyway, because of many of the questions that I get. So first off, when it comes to income trading, there's a difference between trading for income and investing. Investing, when you look at the word investing, you typically are speaking about things that have a longer time frame, a longer time horizon or duration for the investment. So I think of maybe stock and portfolio positions that you hold for the long term, hold for multiple years, maybe even mutual funds or bonds, maybe even some insurance products that have a longer duration and have ideally compounding growth over that time period, over that duration. When it comes to trading for income, I tend to seek higher returns in much shorter time frames, and that also means that I assume more risk. So it requires more attention. So, when you're looking at a bond, a corporate bond that's yielding say 8% with quarterly or annual incomes. Coupons, versus trying to create even a covered call position that's going to yield 5% in a month. I mean, that's a significantly different payoff situation. And I think you need both. You definitely need investing to be a significant portion of your portfolio. And, that varies depending on your risk tolerance, and your age, your time frame, and your desire to assume more risk should be higher, or typically we speak about it being higher when you're younger versus when you're older and possibly looking to plan for retirement. Now, the truth of the matter is there are a lot of people out there who get closer to retirement age and realize that they don't have the nest egg that they really want. And they will turn to trading, more income trading, because this can actually, if you get good at trading for income, this actually will supplement your retirement income or your retirement savings, so that even when you leave the corporate world, you'll be able to continue to produce income from home, via the market. So, but you don't really get anything for free. There is a bit more risk in this, and that's why I like specific types of trades. Many of the trade types that I cover in this show. So, what types of trades create income? Well, you know, anything that's going to create income needs to be able to have a a payoff, produce money within a shorter time frame, like a month or 2 months. Typically, it requires selling something. So we talk about on the show, we talk about covered calls. Even though it's not my favorite trade. It is a trade that many people turn to produce income because you are selling options against stock that you either already own or that you intend to make purchase in the market. The goal, of course, is that the stock goes up and you can make some money, or the stock stays still and you still get to keep the money on the option. The only challenge and the risk, and this is the reason I'm not the biggest fan of it, is that you're still open on that stock. So if the stock takes a significant move down, you will feel it. So you only are cushioned by the option premium that you collect when you sell that call, the call option. The other thing that people do to create income is they'll sell naked options. So selling a naked call option. If you have a large enough account, your brokerage account will allow you to sell call options naked. Naked meaning no hedge, like no stuff, without having stock to cover it. As well, selling puts can be a great way to create some income and also possibly get long a stock at a significantly lower level. So I tend to sell puts if there's a stock that I think is overpriced, but I would like to purchase it at a certain, maybe 10% discount to the market. I'll sell the 10% out of the money put options, and I get paid money to end up buying a position at a much lower price than it currently is. Obviously, with the hope that it's going to go ahead and appreciate back to where it was. And then, again, selling puts requires a larger account size because of the risk and the margin requirements that your brokerage will require. And then, of course, I talk about selling spreads. Selling spreads are great because they don't require as much capital in your account. So you're actually able to create higher return percentages on a much smaller capital use. That's always a positive. Something to think about when you're trying to create income is what size account are you going to have and what's your return on your overall account. So I could probably, if you take a $100,000 position, is it possible to double that in less than a year? Absolutely. If you take $1 million position or $1 billion position, which is the situation that most hedge funds find themselves in, it's harder to double $1 billion, but you can double, smaller volumes much easier. And so selling spreads is one of the ways that I've been able to achieve that sort of goal and that sort of return. And the reason I like selling, I mentioned this on a previous podcast as well, is that when I sell an option, I don't have to be correct on the timing or the direction in general. It's on the buyer. From the moment I sell, I receive money in my account, so that's always a positive. And now the market has to move against me in order for me to lose money. Whereas when I buy an option, I need the market to move in a certain direction, and I need it to do it within that time frame before that option expires. So there's more pressure on the buy than on the sell. When I buy something, I need the market to move, unless like in our debit spreads where I'm purchasing an in the money option. When I sell something, right from the start, I win. And the only way I lose is when the market moves against me, and even then, I typically will find a way to roll out of a position or do something else to make sure that I maintain my levels. So that's it for the topic of the week. If you guys have questions about that or really want to know learn better ways to produce income trading, definitely have a look at my course over at theoptionstudio.com. There's a video there that'll walk you through a little bit of a presentation, tell you a little bit more about me, and I have students in that right now, and they've also, the best part probably is that they have access to me. So when they have questions about options, I've been able to interact directly with them by phone sometimes and also by email. So definitely head over to theoptionstudio.com, take a look at the video. If this is something that you're interested in, I'd love to have you in the class. So let's dive into the returns from last week, the trades from last week. So we'll start off with the covered call. We looked at Zayo Group Holdings, symbol ZAYO, zebra, apple, yellow, orange. At the time, the stock was trading for $28.29. And we looked at buying that stock and selling the April 30 call at 35 cents, looking to collect a 9% return in 4 weeks. Well, Zayo Group Holdings stock finished the week 13 cents higher, closing at $28.42 per share. However, the call which we sold has decreased in price. So sort of like we get to win on both sides of this. So if you bought the option back today, you would actually pay 85 cents, which is exactly what we sold it for last week. So if you close this whole trade today, selling the stock and buying that option back, you get to keep the 13 cents, which the stock made. Of course, if you tried to sell more of that option, you would be able to do so at 60 cents per option or 25 cents lower. So I know that option has decreased in value. A portion of that, of course, is just going to be the time value, but that's great. We sold it. The option is worth less money, and the stock went up a little bit. So if you exit it, like I said, you could do so for a profit. Of course, your highest return is going to be if you hold on to this position and the stock goes even higher. Ideally, goes higher than $30 per share before expiration. So this one appears to be worth holding for a little while longer, but definitely keep an eye on it because, as you guys should know by now, I don't like losing money, and I don't like letting a winner end up becoming a loser. So you definitely have to pay attention. Now, the second trade we looked at last week was the credit spread on Teva Pharmaceuticals, symbol TEVA, Thomas Edward Victor Apple. The stock at the time was trading for $16.33, and we looked at selling the April 16.5 17 call spread at 16 cents. So Teva Pharmaceutical stock fell 65 cents per share this week, ending at $15.68 on Friday. The out-of-the-money call spread, which we sold, is even more out of the money now. So we sold the spread at 16 cents. We currently could buy it back for 10 cents. So that's roughly 37.5% of your total possible return in 1 week. It's easy to overlook 6 cents per spread, but when you consider that your maximum possible gain on this was 16 cents or $16, it's good. You made $6 on $16 in 1 week, right? The break-even point for the spread is a stock price of $16.66 per share, which means that we're nearly $1 away from our break-even. That means that there's really no need to run to exit this trade. This trade has 3 more weeks of 3 more weeks to last before expiration. So if you stay in it, you might be able to go ahead and capture the other 10 cents of profit per spread. So this was a winner as well. Take the win. And then our final trade last week was a debit spread on Macy's. At the time, Macy's stock was trading for $23.31, and we looked at buying the April 24 23.5 put spread for 34 cents, which created a maximum gain of 15 cents per spread, or possibility of 47% return in 4 weeks. Well, this one did not work out for us. Macy's stock rose 72 cents, closing on Friday at $24.03 per share. Now, our in the money put spread, which we bought, is now out of the money. We paid 34 cents for it, and if we were to sell it right now, we would only receive 16 cents. So that means that we've lost 18 cents per spread, which is slightly more than 50% on the trade in a week. Now, the stock price appears to be moving sideways on the stock chart. So let's think of how we can make money on this trade. So since we own a put spread, we can always look at selling a lower strike spread, lower strike put spread. So if we sold the April 23-22 half put spread, we can collect 9 cents. Now, if you've been listening for a while, you should know that we normally don't sell 50 cents of exposure for 9 cents. However, because we already own the 24-23 half put spread, we are fully protected if this second spread goes in the money. So I would absolutely sell that 23-22 half put spread against this. That brings in 9 cents, right? And I'm also looking at this. We can also sell the April 25-25 half call spread at 10 cents. Now, by selling both of those spreads, which actually is when you sell both this call spread and this additional put spread, that's what we call an iron condor. By selling both spreads, I collect a total of 19 cents of premium before execution cost, of course. So this also creates a scenario where we can afford to give this trade, our original put spread, a little more room to perform. We still want stock to finish lower than $23.50 per share. So if you add in these additional trades, you not only get back to even, but you create a scenario where if stock finishes between $23.50 and $23 per share at expiration in 3 weeks, you not only end up collecting the full 50 cents on that 24-23 half put spread, which we originally bought, right? But you also get to keep the 19 cents that you're going to collect on the outside. So our initial investment was 34 cents on this, hoping to gain 15 cents. We will have actually, if stock finishes between 23 half and $23 per share, you actually add another 19 cents to that. You add another 34 cents. So rather than having a total possible return of 47%, you end up in a scenario where you have a total possible return of 100%. And this is why, once again, why I like option trading. So as you look at this, realize that selling that additional put spread, the lower strike put spread than what you already own, it brings in money, but it does not change. It really doesn't alter your risk that much, because for that spread, that lower spread, to be in the money, it means that your current spread, which you own, also is in the money. So they cancel each other out, right? So there's no additional loss, and you would still keep the money that you are going to collect from selling that higher call spread, right? Let's say the call spread goes in the money. Well, you will have made money from this additional put spread that you sold, and you still it lowers your risk, because right now you've lost money anyway. So just do the math. Like, write this all out, do the math on paper, and I think you'll realize you'll probably get as excited as I do about option trading. And of course, you get new data every day, every week, and I love this sort of maneuvering. You definitely don't want to outmaneuver yourself, but you just realize that there are always ways to continue to make money. So the moment I'm in a position, I'm in that position, and I made a first trade. But if the first trade doesn't yield the results I want, I still have a position on. Now I'm looking at how do I change, how do I alter my position to make money, or at least limit my possibility of loss, right? So that is it for the trades from last week. Feel free, once again, if I went too fast, feel free to ask any questions via email. Of course, you can reach me at eric@theweeklyoption.com. Now, let's go ahead and dive into the trades for this upcoming week. And I'm returning to a handful of names that you guys are familiar with if you've listened to the show. They just offered some opportunities that I like for the week and figured I would cover them this week. So the first one is going to be a covered call on Kronos Group. Now, I talked about them last week because Altria, who was part of the split off with the old Philip Morris. Altria is a big tobacco company. They made a significant investment in Kronos Group to the tune of $1.8 billion. Something, I think it was $1.8 billion. Anyway, this is a tobacco company purchasing a significant chunk of shares in a marijuana stock. This stock, when I last made a trade on it, was trading in the $13 range, $13.50 range. Today, the stock is trading for $18.43. And I'm looking at buying that stock and just selling a April 19 call against it, collecting 96 cents per option. If Kronos Group stock ends higher than $19 per share in 3 weeks, I'll collect 8.3% return. So you enter this trade by buying Kronos stock, symbol CRON, Charles Raymond Oscar Nancy, buying that stock at $18.43, and then selling the April 19 call at 96 cents. This trade makes the most money if stock prices finish above $19 per share. Now, our second trade for the week is going to be a credit spread, and I looked at the Russell 2000 Index ETF, the IWM, Isaac William Mary IWM. That ETF actually finished the week at $153.09 per share. I'm looking at selling the April 155 half call spread, collecting 17 cents. That creates a maximum loss scenario of 33 cents over 3 weeks. But of course, I get to collect that 17 cents today. Now, you enter this trade by selling the April 155 call, $155 call at $1.48, and buying the April 155.50 call at $1.31. That's selling the April 155 call at $1.48 and buying the April 155 half call at $1.31. This is a credit spread because we are selling the spread. And this trade makes the most money if stock prices stay below $155 per share. Right now, they're almost $2 lower than that. So I like where it's starting. And of course, this is a 3-week trade, and I like it. Collecting 17 cents and having $2 of cushion before we really need to consider any possible losses on this. So take a look at that one. And then our final trade is going to be on Advanced Micro Devices. It's debit spread on Advanced Micro Devices, symbol AMD, Apple, Mary, David. Stock ended the week at $25.52 per share, and I am looking at buying the April 24 half 25 call spread, paying 33 cents for this, and that creates a maximum gain scenario of 17 cents or possibly 51% return in 3 weeks. Now, you enter this trade by buying the April 24 half call for $1.68 and selling the April 25 call at $1.35. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $25 per share. So that's it for this week's trades. Hopefully you guys are following along. Thank you for you guys who are listening. The numbers are growing, so if you like option trading and you have friends who also are learning about option trading or have been doing this for a living, feel free to share this podcast. I'd love to have more listeners. It's always fun to have more people reaching out to me. Feel free to email me if you have any questions, or if you just want to say hello. You're more than welcome to. I'm a pretty nice guy most of the time. So you can reach me at eric@theweeklyoption.com. And once again, just thanks for listening. Have a fantastic week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.